Club members here today with a little change to the format. So you'll still be getting the written overview of macro theses and giving some of my thoughts. But today I think it's a lot easier and a lot more visual if I can do video breakdowns of my stock analysis. So company of the month today, or the stock analysis of the month, is going to be one of my highest conviction plays, which is Tidewater. Okay, so Tidewater's an offshore service vessel company, and the theses that I've been following and a lot of my investments are really starting to just hit that inflection point when it comes to the offshore theses and capital expenditure moving into the space. So I'm very excited about that. And we're going to be talking specifically about that as it pertains to Tidewater and some of the returns that I think could potentially be on offer in today's video. Disclaimer, guys, I know you're private, but still, I'm not your financial advisor. I'm not your financial advisor. I'm not any financial advisor. This is not advice. It's my opinion. It's what I am doing. Everything that this channel is my opinion and what documenting what I'm doing. That's it. Doesn't mean it's right. Doesn't mean it's right for you. Caveat emptor, and investor beware. You got to do your own due diligence. Okay. Hopefully we're all adults enough to know that by now. So the macro overview, this is a little bit, it's been updated, even though I didn't update the title. The reason is oil inventories continue to draw. It's just getting worse and worse and worse. No one seems to be looking to increase their CapEx as yet, but when they do, that CapEx is going to go into offshore. And so for many reasons, which I'll explain. The OPEC put, we've seen oil has dipped below $80. It just closed today at, I think, at 76.95. And so it'll be interesting to see what happens with the US government, whether they start to repurchase and replenish their SPR. I'm recording this as of November, where we are supposed to have an end to the SPR release. And so we have had the expected deficit of 3 million barrels a day hasn't occurred as a deficit because A, roughly half of that has been reduced on the demand side due to China not opening up yet. And B, 1.5-ish of that, okay, the other half has been supplied to the market via this, what I call synthetic supply, which is the SPR. So we've maintained in a theoretical deficit, although we've seen oil inventories continue to draw. And with Russian oil likely to officially come offline in roughly 7 days' time, China potentially reopening, that's a wild card. We don't know what will happen on the demand side, but we know for sure that Russian crude will be difficult to get to market. Doesn't mean it won't end up there, of course, but the SPR definitely has to end at some point. So, I mean, this thing just continues to draw. I think that the price action has not reflected what we've expected, what I've expected anyway, in terms of a crude barrel, but what cannot continue must eventually stop. And so if you haven't gone too silly in terms of leverage to the oil price, then you can simply choose to sit and wait it out and wait for things to recover. And interestingly, this week, oil dropped in terms of crude futures, but the price for the oil producers did not drop in step. They've actually increased and strengthened against crude. So a lot of people are expecting that these companies are going to do very, very well once people realize the tightness of the oil market. So it's time to get some talk. There's different ways of doing that. You can purchase call options, sort of a cuppy style play. Equities with large inventory reserves and low decline rates. So you heard Josh Young talk a lot about that. And then a few extra catalysts with this gas to oil switching that's only just starting. So Europe had a pretty mild start to winter, but as you will have seen, no doubt, on Twitter and various places, the cold weather, those meteorological images showing the cold weather about to hit Europe will continue. Once Russian production is officially lost, we'll have this gas to oil switching in terms of industry and extra demand placed on gas for heating, which will mean larger draws in oil and gas. It's as simple as that. So we as a world need more oil exploration. That CapEx has to move in to exploration. Onshore is extremely difficult. Where's it going to go? That's the question. And who will benefit of that capital expenditure from these majors all of a sudden having to spend more money in terms of development and exploration? And I believe a huge beneficiary of that is going to be the offshore oil services space, the drill rigs, and particularly the service vehicles, which we're going to talk about with regards to Tidewater. So an offshore service vehicle will be a key beneficiary. We expect a tripling of the CapEx over the next 30 months. Okay, tripling of the capital flows into the space. And you can look at the CapEx charts, the rig counts, they're starting to tick up, and they're still very, very low. And so we think that we're getting right, or I think that we're getting right on the inflection point. So directly benefit these types of plays. Now, here's the thing. So everyone who's been following my work for a while knows how bullish I am on the likes of Transocean, Valaris, Noble, those sorts of plays. And that's true. The one issue, and I've always said this, the one issue, it's not likely and it may not happen, and I hope it doesn't happen, but we need to acknowledge there is a big left tail risk in that were there to be a big oil spill or a big disaster in the Gulf somewhere, let's say, on an offshore rig, that would likely wipe out the investment because you cannot get insurance at an adequate sum for these types of businesses. So the Transoceans might then be really, really struggling, and it will be likely a suit that would exceed the book value. So I've spoken before about how the book value of Transocean is somewhere around $15, $16. So even if it were to go bankrupt today, as of them filing for Chapter 11, you would still expect to receive a return on your investment with the equity at $4. But the problem is, if you then had liabilities from a lawsuit that from a disaster, that might stretch into the billions, and it would essentially wipe out more than that book value. So we do need to acknowledge that, and we need to take it seriously. The thing I love about a Tidewater is that it pairs this position nicely. It doesn't have that left tail risk because they're only providing service vehicles, not responsible for the rigs themselves. Okay, so they charter their fleet out to the rig operators, and that's their business model. This is also a very nicely paired position if, for someone like me, for instance, I have a very heavy position in the oil producers. And so if the oil producers have to increase their CapEx to increase production, and that I don't imagine that will significantly increase the cash flows anytime soon. But what I have essentially is this setup where, should the producers have to increase their CapEx, that CapEx is going to form the increased income and revenue streams for the likes of a Tidewater and also a Transocean. So Tidewater is set to benefit and pair nicely in my portfolio. Okay, this is the thesis in a one page. So Tidewater looks set to be a beneficiary of huge capital inflows. Their charter offshore vehicles, one rig, so one drill rig needs maybe 2 to 4 OSVs as a general rule of thumb, as I understand it. So for every rig that comes back online, you've got this doubling to quadrupling of demand for offshore vehicles, and Tidewater have the largest fleet, which we'll speak about. And so they're in a great position. We've spoken about left tail risk on the downside. Well, Tidewater actually has right tail risk to the upside. Okay, so when you've got a fleet, so Tidewater have their fleet, and say they've got 100 boats, just as an example. And when only 20 of those are in use, they can't be too picky about the charters that they charge, right? Their day rates are very, very low because there's an oversupply of fleet relative to the demand for rig operation. Okay. As these capital inflows move into the exploration sector and people start to develop more rigs, well, you need more offshore vehicles, and the saturation or the utilization of their fleet moves up. So instead of having 20 boats out of 100, it might be 80 boats to 90 boats. And what we have to ask ourselves is, once we get to that 80 to 90% saturation or utilization rate, are you going to ask for more in terms of your day rates, or are you going to ask for less? Of course, you're going to ask for more. And so you can go from this steady increase in day rates to a huge upside. And because you've got your fixed costs on these things, if you have a huge move to the upside in terms of your income, then you've got massive embedded torque to the bottom line, which is your profit or your cash flow. So you say, okay, but what about the other operators? What about the other providers? And this is where it's really interesting. There's natural barriers to entry into this space. One, because the build time, the shipyards are booked out. So it's not well, it's not feasible from what I understand that you're going to have a huge influx of new vessels coming online in the next 18 to 24 months. They're kind of gridlocked. They're at their saturation point, which means we have this occasion where we could well see this right tail risk in terms of increased day rates. Natural barriers to entry with the specs and regulation, it takes time. These offshore vehicles have to be built to specification. You can't just knock up a dinghy and try and lease it out to a rig operator. There's no way. It doesn't work that way. We're buying this at a steep discount to the book value, not as much as it used to be because the price has run up this year, but we're still getting a decent discount. And as I mentioned, shipyards are full. So we've got this kind of monopoly over the fleet. Okay, so here, let's take a look. What are we going to need to see before we have an increase in capex in terms of shipbuilding or vehicle building? Okay, because if you're getting day rates that are really low and all these companies are losing money, no one in their right mind is going to invest more in more vehicles. Okay, so here we've got the new build cost, assuming day rate, their OPEX, and other costs, assuming a 90% utilization rate for the fleet. 20 years to break even on a net present value. Okay. So the economics here, so this is a really bad economic model. Okay. So things just get terrible until we get to an inflection point where I believe we're getting very, very close to, if not there already, where no one wants to build any more ships. Okay. So even if you were to get day rates to 39,000 a day, which would be about a tripling from most rates at the moment, it's 18 years before you break even. Think about that. So here we're really expecting these day rates to fly to the upside before we see any significant increase in the number of vessels available for rig operators to use. Okay, and then think about the time it takes even to build these things. So Tidewater here, they're the biggest in terms of their fleet. Okay, pretty simple. There are other options here. Tidewater to me seems to be the most feasible, the most logical choice, let's say. So the balance sheet is good, and they've got the fleet there ready to go. Okay, here's a breakdown of the type of vessels they have and their appraised value. So this is very interesting. Appraised value, 1.75 billion. Their enterprise value is less than that. So, if you were to buy it at this particular enterprise value, you're buying it at less than the value of its fleet and less than the appraised value of its fleet. Plus, you have the chance to get this huge upside to the right tail if day rates do what I think that they may well do. Okay, so to me, that's another feather in our cap in terms of the investment case. So this is what happens. Typical cyclical commodity service type business. Things are going well, everyone oversaturates the market, price gets bid up, and then all of a sudden you've got a saturation and the commodity price just plummets. And so there we go. So as you can see at the end of the previous oil bull run, the stock has done nothing since sort of 2016, 2017. Okay, so now this is exactly what we want to look for in terms of a crawling chart that's starting to poke its head up above water. Okay, all I've done here is break that down to the 1 year time frame and use the moving averages. Okay, so let me get that out of the way. So we're well above the moving average of 200 days. We just slightly dip below that 20-day moving average, and so I think this could be a good entry point. Disclosure, I have held some shares since early this year at about $12, I believe it was. And so I have some that have done very, very well. Unfortunately, I had to sell some because I went a little too aggressive in another trade and I had to make up margin. So it's very heartbreaking for me to see the stock continue to climb. But I got a good entry and I'm re-entering. Why? Because the day rates have started to inflect. And I think that the value proposition today is just as good, if not better, than where we were before. Okay, company overview. Ignore the time frame. This was done yesterday. I just didn't change. Not yesterday, this week, but I just didn't change the heading. We've got a revenue at the moment expected to come in at 658 mil, and it's expected to grow at 21% over the next 2 years due to that tightness in the day rate. 200 million EBITDA is analyst estimate. I'm going to talk about why I think that's a little low. CAGR is estimated about 15% over the next few years. 50% over the next few years. Free cash flow, it's starting to break. It's just gotten to break even. So they were bleeding cash. Now day rates have come up, and this is where we really look to, or looks to me to be an attractive entry point. Enterprise value at time of recording, 1.56 billion. And if we look into next year's expectations of free cash flow, you're looking at about a 10% yield. And I think that's extremely, extremely conservative. And the analysts are just mindlessly plugging in numbers. They're not looking at what can happen if we were to get back to a previous bull market day rate. And that's, I think, where the opportunity for this is. What's a reasonable multiple? Don't know. I'm going with maybe 5 times. If you were to get a 20% free cash flow yield, that doesn't seem to be ridiculously exaggerated to me. It seems to be fairly conservative. 50 million shares on issue, and their balance sheet looks very, very good. They've got no real net debt to speak of. Let's take a look at the balance sheet considerations in graphic form. So we've got our market cap, the shares, net debt, price to book, and that's been calculated on the old accounting, obviously, because if we're getting it less than, if you're thinking of book value as the appraised value of the fleet, we're getting it at a discount, as I showed previously. And they've got cash on the balance sheet, plenty of liquidity. Alrighty, if we're looking more at income and cash flow metrics, here's what CapEx is looking at in the rearview mirror. So this is the last 12 months, okay, which is why it doesn't look that crash hot, because day rates have only started to creep up to where we would need them to be. And cash from operations, 1.8 million. It's all rearview mirror stuff, okay. Let's take a look at the leverage this thing has should we get this inflection that I expect. So as we get to that 18.5 thousand dollars per day as a day rate, your free cash flow conversion, and this is from the company, so take it with a grain of salt, but that is expected to be in the 90% range. So for every dollar that, once you're at that point, every dollar above that, 91 cents of it drops to the bottom line as free cash flow, according to this chart. Okay, so it's just one of those businesses where it will lose money until you hit that threshold, and then it has massive operational leverage in terms of its free cash flow generation. Okay, and so if you look at what that would mean as total free cash flow to the company on the left-hand side, we're looking at around $666 million with an average day rate of 18.5 thousand per day, and 666 million on a market cap of, we said, or enterprise value, excuse me, of 1.5 billion. That's pretty attractive. Okay, a little bit over 2 times the cash flow to the entire enterprise value. So let me break it down. Here we've got our fully diluted EV, 1.56. If we just took that, and that's a typo, 666, if we took that day rate, 18,500, and that's almost a 40% free cash flow yield, with us buying at a discount to the appraised value of the fleet. Okay, so are you happy with that? Personally, I'm very happy with that. I think that a 40% free cash flow yield is very enticing, especially when you've got this margin of safety that you're buying the company with a strong balance sheet, so it's got no real net debt, and it has, you're buying it at a discount to the appraised value. So if things really got bad, they could, in theory, sell off their assets to generate more cash. But given the balance sheet, they don't particularly need to do that. If we take our desired scenario, desired outcome, and we go back to 2014 when we had a bull market and oil was, triple figures, and there was a lot of CapEx moving into the space. And for reasons that I've spoken about ad nauseum, I believe that will occur at some point during this next commodity cycle, because we need the oil. Free cash flow would be then around 1.5 billion. If you take the day rate of 18.5 and you almost double it, you get close to 1.5 billion in free cash flow to the enterprise in a year. So that would be more than what we're paying for the entire company. So you'd have a free cash flow yield of over 100% before adding the multiple re-rating. Okay, so even if you weren't going to make your money back on the stock being bid up from a multiple increase, you would be making a hell of a lot just from the yield on the free cash flow alone. So that's my take on the company anyway. Investment thesis. So our key tenants, what am I looking for? Obviously day rates. Day rates need to do what we need them to do, or what I need them to do anyway. I expect that day rates will really take off. I think we could well and truly exceed the previous cycle for day rates on the back of this drawing down of oil inventories. And all of a sudden, we get change in government policies around the world because people realize how silly some of these policies have been. And the capex moves into the space, and these types of operators can charge, well, they have to charge. Their fleet will be so saturated in terms of its utilization, they will charge enormous day rates. The company has ample liquidity to survive up to that point. So we'll need to keep an eye on the balance sheet. So far, so good. The re-rating will occur. So if we get this huge increase in free cash flow, and all of a sudden institutional investors really start to cotton on to how good this thing is, it's not going to trade for 1 times cash flow or less than 1 times. It's going to be bid up. And if we got to 5 times the free cash flow, I think that you're looking at or we might be, if you're invested, I might be looking at a multi-bagger. And so that's it's my thesis given the embedded talk. If we were at 1.5 enterprise value today, and the company starts to generate 1.5 billion in free cash flow on that $33,000 day rate, then if you were to apply a 4 to 5 multiple on that, there's a 4 to 5 bagger already on the re-rate. So that's what I'm looking for. That's what I'm hoping will occur. I think that there's an asymmetry here. The downside, really, I can't see day rates decreasing significantly anytime soon until the number of vessels in the overall global fleet increases. And then you're going to have competition to leasing out your charters. And obviously, given the way the shipyards are at the moment, that's not going to happen for probably 18 months to 2 years at least. So me personally, and just my verdict for me, I'm long, and I'm going to increase that assets under management allocation because I really, really like this company. It is a cyclical, so it can't be in it forever, and we'll need to keep an eye on those tenants that I mentioned, but it's set to have revenue, EBIT, and free cash flow growth with a strong balance sheet, and you're buying it, or I've bought it at a big discount to its appraised value. It also has natural hedging traits with my producer positions, which I mentioned. So there we are, guys. I hope you enjoyed that. I hope you enjoyed this format of the ROI Monthly, and please do let me know what you think. And if you aren't aware, what I would like to also leave you with is this idea of a new premium publication that I and another options trader run. It's called Options Maverick. And for ROI Club members, should you wish to upgrade to the premium service of the Options Maverick, you will get a discount to the value of your entire subscription. So in other words, you'll get your ROI Club subscription free, credited all back to you when you decide to increase your subscription to include the Options Maverick. So you can check that out, guys. We've got option strategies to trade these things at a high pace and get intelligent leverage. We've had some crazy ROIs already. And so I hope that you'll consider that at least for a free trial. Remembering it's a way that you can gain your entire investment on the ROI Club back in one hit. Thanks for watching. Do your own due diligence. I wish you all the best, and I'll be back at least at minimum with another ROI Monthly next month with another great stock analysis. We'll see you then, guys. Take care.